All right, so the uniqueness of the BDC Women in Technology Venture Fund actually comes about as a result of the lack of women in the space. And if you look back, and you know, I'm a little bit older than my panel members here, but when I got into venture capital, because I had sold a company that I was the CEO of, and my lead investor at that time was looking for somebody to sit with him on his side of his family office and manage his investments for him. And so I had negotiated my way to an exit in this company. We'd made him a bunch of money, and he decided that it was a great time for me to learn how the other half lives. And so sitting on the other side of the table, learning how to make investments using his dollars and other people's dollars. And he was an investor at that time in a lot of different technology companies, so the exposure was massive. But the one thing that was consistent was that I was usually the only woman in the room. And you know, you'll maybe appreciate the fact that I started my, again, I'm going to age myself here gracefully, but I started my venture capital career in my early 30s, and I sold my first, second, and third companies by the time I was 31. So you can appreciate kind of, you're in this room at a boardroom table, you know how to build a company, you kind of understand how to do certain things, but you've never written your own check. You see a whole bunch of, you know, old white guys sitting around the table, and you're kind of trying to figure out like what the hell's going on around here. So the Women in Tech Fund started really as a culmination of many years of those activities where there was a few of us, Whitney, who Ha works with as well, who were kind of the only women at the boardroom table, negotiating hard with, you know, sort of a bunch of folks around the boardroom, trying to make deals in venture capital when there really weren't any women in venture capital. I think at that time there might have been like 5 of us. And so I had been in a bunch of different funds, including a couple that I had built and exited on my own. And BDC phoned and said, you know what, there's a gap in the market. There aren't many women in venture capital. You're one of the few. We need to solve this problem. And the other problem that we're solving is the fact that in all of the technology companies, and this is not a bad thing, it's just something we need to solve for. In technology companies in Canada and in the United States, only 2% of the VC dollars go into companies that have women in their C-suites or that are women-led technology businesses or have diverse teams. If you look around the room, virtually or otherwise, this is a very diverse group of people. Diversity is what brings strength to building a company and accelerating that company to be exceptional, not just excellent, but exceptional. And so the fund is designed to solve for those things. And it's designed to solve for putting more women in seats to be investors like Ha and Whitney and others. And it's designed primarily to invest in technology companies at seed stage and Series A as they grow, but to provide the dollars and the extra kind of boots on the ground, so to speak, that will help those companies really accelerate. So you'll see companies in our portfolio like SheerTech, you'll see companies in our portfolio like Swift Medical, very, very broad, you know, sort of stage and sector agnostic, but with that overarching theme that they have women and diverse teams in their C-suite, and those women and diverse leaders are the folks that we're going to back to take those companies and build global champions that can maybe beat Google later on. You never know.
Yeah, that is actually a really interesting take on that. And it's actually pretty cool hearing about your experience, you know, that change in the representation within that industry. And actually, I want to pass this on to Ha. In your experience, in your career, have you seen a notable change in the number of female founders within the tech industry or the number of women working within venture capital as analysts or as partners?
Yeah, that's a very good question. And I would say, you know, back in the time of Michelle and Whitney, we don't see a lot of women in this space. But thanks to the trailblazer like Michelle and Whitney, we are now actually experiencing a really good momentum of women getting into the technology and venture capital space. And we see a couple of communities that focus on women in tech as well women in venture capital that are growing in numbers of members, which is really positive for our industry. In our deal flow alone, we kind of been tracking the number of deals that have C-suites, female women in the C-suites level, and it increased from about 10% in 2020 to almost 20% in 2021. And we are focusing on a very dry space, which is the industrial tech space. And it's really rare to see, some of the women that are getting into that space. But again, I mean, even in Canada, we started to see a couple of really good growth stage company with late stage revenue streams like Renoran, the deal that Michelle just did that had presentations of women in the C-suite, which to me is a really positive signals that there are more and more women getting into the space and getting more successful in the space with a better community and resource around.
Yeah, that is actually really promising to hear. Really exciting as well. And that answer actually included a few of the topics that we'll touch on a little bit later when we get into the deal specific questions. But moving on from that, I want to ask you, Tim, since you're pretty early on in your career, but you have achieved a remarkable amount of success, we want to ask, what did your role initially entail as an analyst? And how has your day-to-day responsibilities changed now that you're an investor at Panache?
Yeah, so like, I guess when I got in, I didn't have any background in the industry. So it was literally like me shadowing one of the partners and just like, and like venture is kind of you can kind of think about it like an apprenticeship where you work closely with someone who's more experienced than you, and you try to like learn their skills through osmosis. So it's like I was shadowing this partner for like investor meetings, founder meetings, and due diligence calls, etc. And then like eventually, like you kind of know how things are done theoretically, and then you just you just kind of like, I guess, insert yourself into conversations with founders while the partner is leading it. And then eventually it's like 50-50. Then it's like, I start leading most of it and the partner kind of just sits back, and then he'll either like shoot me things to say on Slack and kind of like coach me that way. And then now it's like I'm doing, I take most first calls with founders alone. And then it's like, I'm doing running point on due diligence, and now I'm doing like most things alone, minus, say pitching the fund to investors.
Okay, that's actually really, really cool to hear. So then building off of this, when you're looking for deal flow or finding new companies to invest in, I know actually all three of you have backgrounds in entrepreneurship. From your experience, what can entrepreneurs do to stand out from other companies? And how do you find the investments or the companies that you do end up investing in? What is the process behind that?
Yeah, it's pretty varied. And maybe it'd be good to like, I guess, caveat that it's different depending on the stage of the company, right? So it's like Panache focuses on pre-seed and seed. And at pre-seed and seed, it's like, they're still figuring out the business model, they're still figuring out the product, they're still figuring out like, they're even still figuring out who their customer is. So it's like the thing that we really like, the only signal that we have to be like, hey, this is an interesting company is like founder and market. So generally for us, we try to look for, I guess, things that indicate to us that this founder is special in some way, whether like they've managed to move the needle on their business in like a reasonably short period of time, or they've done something else that's like super kind of unique or interesting or eye-catching, right? So two examples. One of our founders in Victoria, he like did business plan competitions to win money to pay for his tuition throughout all of university, and like paid all of his university just doing that. And to us, that was kind of like interesting. And even though he was a first-time entrepreneur, it's like that in and of itself was like entrepreneurial to us, right? So we're like, okay, we want to talk to you. We want to like learn, like hear about your business idea, right? And then this other founder, again, in Vancouver, and like, you know, the West Coast is kind of a hotbed for entrepreneurship right now. But when he was in university, he wanted to be an entrepreneur, but his problem was that he had no money. So what he did was that like he learned that there was this I guess promo for developers in the iOS store where new developers would get like a $2,000 credit or something like AWS credit if they published an app in the App Store. And so what he did was he made like 20 different email accounts, and then he created 20 different apps and published 20 apps in the App Store and got, I think, like 40 grand of AWS credits, and he sold them on eBay for half off to create like 20 grand of startup capital, and then started his business with that, right? So it's like, to us, that was also really impressive. So we're like, we want to talk to this guy, right? So it's just like, you know, what we've noticed with our best founders is like they've all done kind of stuff like this, which which is entrepreneurial.
Wow, that is definitely really cool. I actually want to get your take as well, Michelle. You touched on just previously about selling your business when you were 30 and then transitioning into VC. Before you sold your business, when you were creating it, what were some tactics you used as an entrepreneur to attract funding? And what would you recommend to entrepreneurs who are trying to attract funding and trying to stand out from the crowd?
Well, when I was trying to attract funding, it was a different time. But I think if I were going to start a business today, I would be doing exactly what the entrepreneurs that Tim's talking about are trying to do. You need to be a bit unique, and you need to think outside the box. A lot of founders that come to see us, instead of doing the whole pitch deck thing, they'll often, you know, if it's a demo, they might send us a link to the demo and say, hey, we'd like to walk you through it, or, you know, let's meet for a coffee, and they bring their laptop and we sit and we'll actually, like, in real time go through the demonstration, as opposed to the pitch for, you know, the purse kind of thing and just asking for the money. They'll walk us through the why of how it's interesting and what problem they're trying to solve, and, you know, potentially who their customers are. But that's really what we look for. And we look for that sort of passion, but also the guts to be able to think about a market a different way and attack that market from a different way. So we're looking for those kinds of perspectives. And certainly when I was, you know, building my companies, we were breaking new ground. One of my companies was in solar panels before solar panels were a thing. And well, that's the story for another day, but when we're not being recorded. But but a very interesting, you know, interesting business. But you're seeing a lot of those companies now, and we're at an enormously great inflection point for starting up a business today and really disrupting an industry. Ha's seeing this all the time in her space, but there's never been such a great time to build a technology company and really, like, create new industries and create new markets. This is the time that is going to happen, and it's going to happen for the next few years.
Yeah, definitely. There's been significant growth, especially spurred from the pandemic, actually trying to find new solutions to all these problems. But when you are meeting with these entrepreneurs, actually, I think, Ha, maybe you could take a stab at this. What are some red flags, actually, that you look out for before you commit to a company, and why do they appear to be red flags?
Yeah, thank you. So, you know, just to give you some context, we are a venture growth fund, which means that we're trying to focus on companies that are past that early phase of commercialization. And so we focus a lot on the traction that the company has. And for us, we're trying to stay away from companies that has low traction after a long period of time. And the length of the time depends a lot on the nature of the business. So let's say for a B2B startup, if it has only one customer or one pilot after 12 to 18 months, this becomes a big red flag for us. The low traction usually indicates two possibilities here. The first is the team is not working hard enough on selling the product. And the second is more dangerous, which is the product has been rejected by the market. They just don't have the market fit, which is one of the key things for us. I also am personally not impressed with entrepreneurs who say they have no competition or who cannot name any major competition in their space, especially in the market that we know for sure is getting crowded. So let's say I'm talking to somebody who work in predictive maintenance. It's a very crowded market. And if he come up and he say, no, we don't have any competition, or he cannot name any, credible competition, at least like, C3 IoT, someone that everyone knows, that's going to be a red flag for me personally. People who say they have no competition are those who either don't do enough homework or in too much of a niche market that is not attractive enough for others to jump in. And so these are just two major kind of examples of the things that, we kind of notice when we first talk to entrepreneurs. I mean, we are in the business of saying no. And so there's a lot of other things as well that could kind of make and break the deal. And we are not, unless there's something major happen, we'll try to kind of, look for good things on the deal as well. But I would say, there are some certain thing like market, competition, technology, and team, you should do a lot of homework on before you talk to entrepreneur.
Yeah, definitely. Those are some really interesting takes. Maybe Tim, you could take a stab at this as well. If there are some other red flags that you've noticed from your experience working as an analyst and both an investor.
Sure. Building on top of everything that Haz mentioned, maybe like one of the biggest ones for us is when they lack clarity of thought. So like, a question that we always ask founders is, what is your vision for the company, right? And it's like, what do you want your company to be 5 to 10 years from now? And I think it's like really good founders are able to articulate that vision very clearly. And I think it's like, the reason why this is so important is not only because like, if you can't do it, it's tough for you to attract capital, but it's like, if you can't articulate like what you're building and why it's important, is like, how are you going to attract talent to come and help you build that vision, right? And it's like, the thing about startups is that they're really tough, meaning that you need to attract the best talent. And it's like the best talent will have no problem getting a job at Google or Amazon and getting paid a few $100,000 right out of school, right? And it's like the only way for you to convince them to, take whatever salary you can pay them is selling your vision to them, which can only happen if it's super, super clear.
Yeah, definitely. That is really interesting. Building off of that, actually, when working with entrepreneurs and early stage or even mid-stage businesses, a lot of times with startups, many of them will not turn a profit or as great of a profit. So when you have all these companies within your portfolios, how do you actually measure success? And is that different for each company, or are there general, you could say, milestones that you try to reach with each business that you work with?
Yeah, so it is different for each company. And especially in our portfolio, like right now we have about 100 companies in our portfolio, each at, different stages. And I think a very quick and dirty way to measure success in venture capital, I guess, at the early stages is like if they're able to raise the next round, because, and even though that's not like the ultimate measure of success, because it's like, you're trying to build a very profitable business. You're not trying to just raise a ton of money. But it's like, even if, let's say you're growing really rapidly early on, it's like that can taper off in a couple of years, right? So it's like you can't really tell whether the company's going to ultimately be successful like 10 years down the road. So at least in the short term, the way that we measure success is, in addition to all the metrics that everyone normally measures, is like, are they able to like quickly raise the next round and continue building product and getting customers and all that stuff.
Yeah, that is really interesting. I'll pass this to Hai and Michelle as well, if you guys would just want to take a stab at it, if there's any unique measures you guys use.
Well, I think, as teams rightly said, it's really different from companies to company and business to business. So within our portfolio, there are some businesses that have the business model, which a lot of benchmark, let's say, SaaS business. Then you can use, some of the metrics to measure it, like how a particular company is performing compared to their peers in the same industry. And that's one way. The other is we really kind of look back, especially when we do due diligence, we look back at the previous board meetings, and we try to see if the company has stick with the plan or, has achieved the milestone that they set out in the past. And either it is, a product release, either it is a contract signed with client, either it is partnership expansions. The team that is committed to the goal and achieve that are usually the team that will be successful in the future, based on our experience.
Yeah, I'd agree. I think the typical way we measure is based on a company by company. And so if it's pre-seed, you're going to measure success, to Tim's point, very differently than if it's a rental run, which, is a Series C. They're doing a lot of revenues. They're even a positive. They're in a very different part of the ecosystem. But I think one of the things that, people don't really understand about venture, and maybe it's worth mentioning here, is that we're all talking about portfolios. So we have a group of companies in our portfolio. Tim has 100. I don't even remember now how many McRock has. We have, sort of 35. But we also look at success from the standpoint of how are those companies doing relative to their ability to build something at scale, ultimately with the goal to exit that business. So we want to exit our position out to, through the IPO, through a acquisition or some other way. And so we also measure our success as a fund based on the ability to exit the portfolio over time. So when you think about building a company and seeking venture capital as a way to capitalize the business, you also need to be thinking about the venture capital investor wanting to get their money. They'll put their money into the company and they'll make that investment in you to help you build the business. But at the end of the day, we're also looking for that exit. So we are thinking about sort of both sides of the coin. That's something that I think people need to just keep in mind as our measure of success is when we return the fund and our LPs are all really happy. That's a big check mark as well, and something that we don't forget.
Yeah, those are definitely some great points. Actually, building off of your take right now, when you're considering your exit strategy and that long-term plan, is that determined before the initial investment is made? Or is this like a plan that's continuously changed or created as you work with the business?
So when we make an investment, we're typically looking at how big is this market? What's the competition in the market, and can this company win in the market? And by winning, we mean, can they be big enough? Can they build themselves to be big enough, competitive enough that somebody wants to buy them because it makes sense for them to do so? Or conversely, they could be IPOable because they've got a big enough market opportunity. If you think about some of the companies that have IPO'd in the last year, the reason they IPO'd was mostly for obvious reasons, but there was some inflection point that allowed that to take place. So when we think about it, we're thinking about it in those terms and what that means sort of as our end game. So we don't plan in our first investment that we're going to exit in 3 years and it's going to look like this, because the company at the seed stage is probably going to look very different than the company at exit. Likely it's going to look very different at exit, but we will plan based on just where that market is, where the company is going relative to the competition, what the space might look like, what the opportunity for exit is. And then we build that into our models and into the amount of money we put into the business at the beginning and the amount of follow-on that we hold for that company as we kind of go on that journey with the entrepreneur and help them and the team build that company into the global markets.
Yeah, and Michelle, it's also worth to note that, the venture capital firm has a lifetime of 10 years. And so, the window of exit really depends on, at which year of the fund you invest in that particular investment. So if you invest in an investment at the year 6, then you're probably going to have 3 years left to, stay in that business. And so one of the very smart questions that entrepreneurs should ask the VC is like, which part of your fund is it like you just started the fund, or you in the kind of middle, or toward the end of the funds, because that will give them an idea of like how long they can work with this VC for an exit and liquidity event.
Yeah, those are definitely both very insightful takes on this topic. Actually, circling back to, I think, what Had touched on just a few minutes back, dealing with a large portfolio. So McRock Capital obviously has a huge amount of companies that they work with and they manage. As a partner, or as the vice president, actually, how do you manage working with such a large portfolio, and how do you distribute your time? Because I'm sure as a member of multiple boards, you're required to take on some sort of a role within the company's operations.
Yeah, that's a very good question, and I think just wanted to confirm at McRock we have about 20 portfolio companies. In my previous fund we had larger because it was an earlier stage fund, but 20 portfolio companies, and we have a team of about 5 investment professionals, including the 2 partners, and I'm sure Michelle and team, they has pretty much a lean team compared to the member portfolio they have as well. And so, there's always that a little bit of kind of a tension in terms of how we allocate our time in each portfolio. And I have to say, it's not like, it is not equal across the portfolio that, we spend like the exact amount of time per portfolio per week. It really depends on the project we work with them. So for example, we've been working very closely with a couple of portfolio companies because they are having some of the interest from the buyers for M&A. And so, we spend a lot of time working with them on building the business case, thinking strategically about how to position it for, a premium price and so on and so forth. So it's really depending on, the time of the year, the kind of project it come up. But I have to say, the traditions of the VC fund is being nimble. We're not going to have 100 people in the fund to deal with 100 portfolio. And so one of the things that I really like about VC fund is a very demanding business, but it makes you feel really energetic because you got put into different pathways at the same time. So it is a blessing and a curse in this industry, and we just got to deal with it.
Yeah, and actually touching off of what Had just brought up right now, as a pretty lean fund like Panache, what are some of the most exciting projects that you've had to work on, Tim, in your experience? Because I'd imagine with a smaller team, you're forced to wear a lot of different hats, required to work in a lot of different roles. So love to get your take on that.
Yeah, to me, like maybe the most exciting, maybe on the helping founders side, and then on the fund side. Like on the helping founders side, I think the most exciting projects that I've worked on is really just helping them build their deck to help them raise their next fund. And like the reason why to me that's so exciting is like it's I really love storytelling, and it's like in early stage, the deck is literally a story that founders have to tell to convince other people to raise money, right? So then it's like the game is how do they tell the story in a way that makes people want to like pay a premium for that company when they're like still figuring out a ton of things. And then on the I guess fun and more admin side of things, because of my engineering background, one of my first projects, and I guess a project that I just like keep helping the fund with, is that I actually helped the fund build their investment model, which meant like I helped the fund determine, how many companies that they want, like they should invest in at pre-seed and seed, and how much capital should go into each of these buckets, and what our follow-on rate should be, and all that stuff. And so that was, that really got like the engineering side of my brain excited.
Yeah, that is really interesting to hear about. Circling back to actually a topic that you touched on. So when you are working with these funds, and I'd actually love to get both your takes, Michelle and Ha as well, how do you determine how much capital a business needs to raise within a specific funding round? Because I would imagine every business is different, so their capital needs will be different as well. but do you try to aim for a year, 2 years? And is it possible for founders to raise too much capital?
Yeah. So our recommendation is generally 12 to 18 months of runway. And the reason for that is because like it gives them a good year to like operate the business and, you know, make the business more valuable. And then it gives them like this 6-month buffer to try to raise their next round because, you know, we've met a lot of founders that, you know, believe that they'll raise in like 1 or 2, but usually it takes more than that. So you do want that buffer, so that you can raise your next round from a position of power, right? Because it's like if an investor knows that you're like running low on runway and that like you'll probably just take any terms and they can really, I guess, screw you. And then in terms of like, can you raise too much? You can absolutely raise too much. And overcapitalize the business. And what that means is like, you just dilute yourself more as a founder, right? And then I guess the risk there from an investor perspective is that like if a founder dilutes themselves too much by raising too much, they might not be incentivized to like work on this for the next 10 years because even if let's say they build it to $1 billion company, but they only have 1% of the company, it's like they don't really walk away with a lot, right? And then from the founder's side, it's like, yeah, it's just you don't want to dilute yourself too much.
Yeah, and I'd like to chime in and say for us, it's really a function of how much capital you need to unlock the next phase of your business. And it is marked by either a revenue threshold or a release of a very important product feature, and how much capital you need to get to that next stage. And I agree with Tim 100%. In my previous life, we actually had a case where a portfolio company of ours raised a huge amount of money. It was $60 million at the time. And then without proper governance in place, we ended up in a situation where there's fraud happen. And then the company burned through that 60 million in only 18 months. And so too much capital without proper governance is the kiss of death for founders in a lot of cases.
Yeah, no, 100% agree. I think the, you know, Tim and Hob covered it off nicely. I think the only thing I would add is just, you know, when we're looking at how much money a company needs, we're also considering the valuation and the price that will be put on that capital. And so when you're thinking about how they're going to, what the money is going to be used for, so say it's 50 million that they need to grow the business and meet the revenue milestones or product milestones or whatever the milestones are, from a use of proceeds perspective, we're also thinking about, is the valuation that is going to be attributed to that money something that the company can actually grow into? So can you generate the revenues based on the capital that you've brought into the business enough to get you to that valuation? Because that's the other big sort of limitation that is happening in the market today. Is you're seeing it everywhere. You're seeing lots of frothy valuations, lots of noise in the marketplace from BetaKid and, you know, all the news media feeds around big valuations, big fundraising, and big valuations, and that can have the opposite effect of on the business if you're not able to generate the revenues that allow you to grow into that, and it will negatively impact the next round of financing and dilute you and your potentially the other investors. So you kind of have to watch that, and it kind of comes back full circle.
Yeah, yeah, those are all great points, because I feel like when it comes to discussing entrepreneurship and early stage businesses, a lot of the focus is towards how to get money, but not so much so as determining how much money is required and balancing that with diluting your business. And as Tim actually touched on, if you do take in too much capital and bring in a lot of other investors, you can dilute your share. In your experience, have you ever been reluctant or had trouble investing or working with a startup because of the other investors that were involved? does that play a role in determining whether you want to take on a project or not?
Well, we always syndicate. We never go alone ever. We always syndicate with other investors. So we're always looking at who's around the table, less so from a can we work together, but more so can we collectively add value to the company, and do the other investors collectively contribute to the growth of the business? If we're all aligned in terms of that goal and objective, and aligned with the management team to achieve on that goal and objective, we'll find a way. But typically it's, you know, we're syndicating with investors that have the same interest and alignment that we do in terms of being able to grow the business and having the relationship with the senior lead team, regardless, frankly, of stage, that are going to be able to wrap their arms around that management team and help them actually achieve on the goal. That's one of the things that you know, makes a syndication work. And if there's not alignment, you usually know that before you ever get to a close, and usually the management team sorts that out before that happens, because it's really the onus on the management team to be thinking about what kinds of investors they want to have in their business to help them grow the company. It's as much on their shoulders as it is on anybody else's. And as existing investors, we're there to kind of help them see, you know, all of the different components of that, so that they make a good informed decision.
Yeah, and also, you know, speaking from our experience, when we talk about a deal and we think about syndicating, there's always, you know, some groups that we love to work with, like Michelle and Tim and Pat, and then there's a couple of groups that we had history with before, or, you know, we heard story before, that we would try to be really mindful of working with them. It's not like 100%, you know, a blacklist, but, you know, we need to think a little bit careful about working with this one. And so, you know, the venture capital market is a small market, especially in Canada. So you need to think really carefully about how you build your reputation, and, you know, who you align with, and who you work with historically and in the future.
Yeah, those are actually both really great points that both you and Michelle brought up. Actually, building off of that, when working with investors and venture capitalists, from your experience, and actually maybe Tim, you could take a stab at this. Apart from the actual capital that the business will be able to raise, what other factors should entrepreneurs look for in the investors they decide to bring on board? Or on the flip side, do they even realistically have that luxury of being able to pick and choose?
Yeah, well, I guess whether you have the luxury or not depends on how hot of a company and of a founder you are. If you're, you know, if you don't have, you know, what we like to say within the firm, fundraising magic, then it's like, you know, you kind of just take what you can get from who you can get it from. But it's like, if you do get to pick and choose, then you know, you want to choose the people who will be the most value add to your business, right? And who can help you kind of bring it to the next milestone, and help you kind of help you address all of the areas of help that you need help with, right? So yeah, I'd say that's the biggest thing. It's like capital is cheap. It's pretty widely available now. And so the big differentiator between investors is like what they can do for you specifically to take you to the next stage.
Yeah, that is actually a really interesting take. Related to that topic, transitioning over just a little bit, when it comes to capital available in the marketplace for entrepreneurs, from your experience, and maybe we could get take from all the panelists, has there been any significant changes in the last 2.5 years due to the COVID pandemic? Has that increased the amount of capital available for entrepreneurs? Have venture capitalists been using this as an opportunity to enter new industries? Or has it had an opposite effect of sucking capital out of the marketplace and making it harder to start businesses?
Yeah, I mean, what we've seen is like, you know, there was kind of a pause in the industry in like March 2020 when COVID started, and like people were shell shocked and like everyone's still, I guess, figuring out what to do. But then and I guess it's similar to like the public markets where there was that dip and then it like came back stronger than ever. So now you know, we thought that valuations were either going to go down or stay flat, and now valuations are like higher than ever. And especially with, I guess, emerging industries like crypto and DeFi and DAOs and NFTs, it's like the valuations in that industry are absolutely crazy, right? So it's like a pre-seed deal in Canada, probably now you could is probably like within 10 to 15 million, which is kind of expensive, but it's like in the crypto world, it's like we're seeing $25 million pre-money valuation pre-seed deals, right? So it's like I would say that the funding environment in venture capital is hotter than ever. Whether that continues with like is TBD, because of like, you know, we're starting to hear things about, you know, changes to interest rate and stuff like that.
Well, I would say, you know, in our particular business and industry, when you look under the hood, there's really a bifurcation happening. So on one end of the spectrum, you have company, and that often are kind of earlier stage company at angel stage, and because angel investment, the angel investor community, they make deals based on kind of human interaction. A lot of that is, you know, you grab coffee with the founders, you know, you have dinners with them, and you get to know them at the personal level. That has slowed down a little bit in our industry. On the other hand, though, we see a lot of mega deals, the deal that has a size of 100 million, 50 million or more, on companies that are either in a particular space, such as artificial intelligence, such as climate tech, or some company that have seen great growth over the couple of years. And so it is kind of happening over the last 2 years right now. And the competition has been heightened for you know, investors that are in the hot sectors and the kind of, you know, hot stage on that side. And so I have to say, you know, it's been a very strange time since the pandemic happening. We can say, you know, it's slowed down, but we can say it's getting accelerated.
Yeah, and you're seeing a lot of, you know, there's a lot of money in the market right now. So if you're, you know, it's a great time to be an entrepreneur if you want to build a company and seek financing. But there's a lot of money in the market, and it's not just VCs that have it. The you know, the hedge funds are going earlier. The private equity folks are coming downstream. The family offices are getting into venture and carving out allocations of their family offices to specifically put money into either early stage tech or into funds that are investing in tech. So you're seeing a lot of that happening in Canada, and you're also seeing a lot of US investors and foreign investors from Europe coming into Canada looking at deals, mid-market deals. So, you know, think sort of that Series A, Series B rounds, but a lot more money coming into Canada, and Canada being seen really as a hotspot for disruptive industries, very entrepreneurial culture. We've got specialties in AI, in ag, in oil and gas technologies, in some space. There's a lot of different capabilities in Canada that are emerging markets in and of themselves. So there's a lot more money coming into Canada than I've ever seen in the last 10 years of being in the industry. So so that bodes well for entrepreneurs and frankly for investors, because there's a lot more opportunity to syndicate with bigger. You know, we just did a deal with Tiger, and Tiger's they just raised a $11 billion fund. It's insane, but and all to the good. But they're going to be a great investor with us in RenoRun as an example, and that's public. You can Google search them and find out all about it. But those are the kinds of investors that are also coming into the country, and they're writing big checks, and they've got big arms that they can wrap around companies and the teams as they're building them out into different markets in different parts of the world.
Yeah, I mean, the last few years have definitely been a time of extreme change. And it feels like a lot of the news cycle is always focused on the negative, the aspects of life that have been negatively affected by COVID, which are obviously pretty large. But it is also really promising to hear all of the points that you three brought up of the benefits that we've seen, especially within the Canadian marketplace for the availability of capital and entrepreneurship. And that actually takes us to our next topic. So here at TechStart, majority of the entrepreneurs we bring in are from Canada, started businesses in the prairies, tech businesses primarily. And so we'd love to get actually everybody's take on this, but from your guys' experience, what are some advantages that entrepreneurs and also investors have working within the tech industry within Canada in comparison to tech hubs such as Silicon Valley, for example, which is the most well-known?
Well, I would say, I think we have lots of technical potential given the brain power and rich talent pool, which is filled by strong university system here in Canada. And we also have great immigration policies, as you know, speaking from an immigrant standpoint, that allow many highly educated immigrants to come to Canada as well. And I think, the key here is really to keep fostering the innovation ecosystem to make sure that the technology and the talent coming out, all of these, have the good foundation to grow and to scale into larger businesses.
Yeah, and we also have, in addition to a great university ecosystem, we also have significant programs that support R&D at the very early stages and as companies start to develop. So as you're building your technology capabilities, you're honing your product market fit and getting your MVPs sorted out, there's a lot of money available to support that and to continue to support that. There's SHRED credits and, NRC, IRAP, and other organizations. We've got Amy in Alberta that has funding, a number of other things that will help spur that R&D in that early stage of innovation, which is frankly seen as a competitive advantage worldwide, and that no other country does as well as Canada does. And that I would suggest, if you're thinking about building a company, lever all of those aspects and bring that capital. It's non-dilutive money. You can bring it into your business early on, and it'll help you iterate faster than you might necessarily be if you're sitting in the US trying to do the same thing.
Yeah, and maybe to throw in one last point, like I think because Canada is a smaller ecosystem, it's a lot friendlier than, let's say, Silicon Valley or New York, and it's relatively easy to, like, I guess, get in front of any VC in Canada, right? And it's like if you get in front of one, you pretty much have access to all of them, because that one VC can like intro you to the rest of them.
Yeah, that is definitely a really interesting take. I mean, the main kind of you could say base of entrepreneurship is always Silicon Valley, just because of the number of startups and companies down there. But it is really good to shed some light on the advantages we have here in Canada. And just circling back to a topic we touched on earlier about a lot of new technologies really taking off and heating up in the last 2-3 years, like blockchain, and also the applications of video chat and VR. From your experience, what would be some industry verticals that your fund or you personally find extremely exciting, or that you believe have the most potential right now? I'll just throw that out to whoever wants to take a stab at it first.
Yeah, let me take a stab at it. So, given our background and the industry that we focus on, we are super excited about the use of AI analytics in a number of industrial markets. Something like smart manufacturing, smart energy, supply chain, critical infrastructure like the cities, the buildings, and so on and so forth. And for the last decades, we've been building a foundation of data from the physical world, which here we like to call the body of the industrial Internet of Things. And now I believe that we are at that inflection point, and we are at the time to apply the data processing techniques like AI, some of the digital technology like blockchain, to generate actionable insights for productivity increase, process optimization, or asset management. And so it's really less about a specific vertical. It's really about different applications and different themes under these industrial markets, digital industrial market that we see. Predictive maintenance, asset management, supply chain optimizations, connected workers, or factory automations are the themes that we consider kind of within our sweet spot.
Yeah, I think we're sort of aligned with that in terms of what Ha just described. But I think sort of to extrapolate from there is sort of using artificial intelligence as the means to make actionable insights on anything, but then applying that to things, not just in the industry, but we also look at the digitization of health, how you're going to personalize, how health is going to be personalized in the future, and the use of artificial intelligence to streamline a lot of those processes, the future of work and how we're going to do, we're already experiencing that now, but taking that to the next level of future of work, the way in which people move, the way in which goods and services move, and supply chain systematization around that, and the ability to connect all of the dots. So not just industrial, but also people, places, things, so that we're able to manage ourselves and live in a let's say a more sustainable environment, a more sustainable world than we have in the past, and kind of using technologies to be able to enable that.
And then for Panache, I mean, we're a generalist fund, so we tend to look at like everything across the board. And I wouldn't really say that we have a preference, but right now as a firm, like an area that we're really interested in is Web3. And part of that is because it is so noisy. But usually when things are this noisy, it's like, there's a lot of crap, but there's also a lot of opportunity, right? And it's like, you can kind of think about Web3 like, perhaps the internet in the 90s when, you have a lot of tech startups that went bust, but then it's like Amazon also emerged, right? So it's like, that's kind of how we're looking at it. And we're still really trying to grapple the industry. But yeah, I mean, it's been really interesting just like learning how people look at Web3 and what, blockchain and tokenization enables and how it like creates new incentive structures.
Yeah, definitely. And I mean, what we've seen over the last few years, especially as Michelle brought up, the digitization of more and more processes has definitely, accelerated that need for new technologies and implementing a lot of the new tech that makes the headlines, such as blockchain and AI, and using it for more like nuanced applications. But actually circling back to one of the points you brought up earlier about the investment process kind of moving downstream and basically the rising costs of early round investments, pre-seed rounds of up to 15 million. Focusing back on that, how do you balance, or what strategies do you use to mitigate the risk associated with investing in these early stage businesses, especially tech businesses? And are there any you could say strategies you use to mitigate the risk you take on?
Yeah, I mean, I guess in terms of mitigating the risk, that's like, I guess it is tough at the early stages because it's like, it's literally like a guy with an idea, right? So it's like the risk is very, very high. And like when you invest in pre-seed and seed, I think like there's some articles online of people that have done studies. It's like the failure rate is, 70, 80%. And really you're like banking on the one startup that becomes the next Shopify or something like that, and that will return your fund multiple times over. But obviously, like ways that we mitigate risk is we have an investment committee, which is a bunch of partners who will who all have their own worldview, and they'll like look at the deal and perhaps look at the deal in a way that you may not have looked at, right? Because as investors, we all have blind spots. And then, like Michelle said, you syndicate a deal because you may not have all of the expertise that you need to help this founder. So you bring in other investors that can help the founders in ways that you can't. And then I guess it's like owning enough of the company such that if it becomes this humongous outcome, you actually get like a big return that returns your fund. That's another way to mitigate risk. But so, there are all these things that we do, but like in terms of mitigating it, like, I don't know, like banks mitigate risk, it's like, you don't really have you don't really have that in early stage venture, at least.
Yeah, and as we, getting to later stage, I guess, the more data points we have on the historical performance, we're going to wrap around, a lot more analysis in terms of, revenue growth, in terms of the metrics compared to the benchmark. But we also started to use a couple of software tools to assess the team, because team is obviously one of the most important factor that decide the success of the company. And one of that is actually one of the portfolio company of Michelle, which is called Plum HR, where they use artificial intelligence to create a system that evaluates the different personality traits as well as skills of the executive and the founders to see how fit they are with the position they are in. And we're also using another software tool called Diversio to really evaluate the culture of the team, how good the culture in terms of diversity and inclusion, but also, kind of everyone think about the mission of the company and the way, they work as a team, the dynamic of the team. And we find it more and more useful, as now we don't have a lot of time spent in person with the companies that we're going to invest in anymore. And so, getting on these insights and analytics is very important for us to mitigate the risks that could come, from a team standpoint as well as a business standpoint.
Yeah, we use similar tools, and we do technical diligence as well. So we have a few people on the team that are specialists in artificial intelligence and deep data. And so we'll get them to do technology reviews and just make sure that things are lining up. Even if the technology is really early, they're often super helpful at helping the team actually understand where their own blind spots might be as they're developing the tech, so that they can start to think about, as they build out the product roadmap, what that's going to look like. And that helps us get comfortable with whether or not the technology is, sound, is it built on the right rails? All of those things are important as well. But I think, one of the things we also do is, when you're dealing with term sheets and you're negotiating to make sure that it's a win-win for everybody. And that is in and of itself a way to manage risk on both sides. So we do a lot of back and forth discussions with the management team to make sure that the terms that we've set forth, if we're leading the term sheet or participating as a co-lead, match what the intention of the spirit of the investment is. And by getting to agreement on some of those terms, that is a way in which we align and manage our risk, both from the entrepreneur perspective and from the investor perspective. And that's a useful tool.
Yeah, definitely. That is actually really cool to hear about, just those strategies that you guys are implementing when considering these potential projects to take on. Building off of that slightly, we want to touch on one of McRock Capital's investments. So recently, McRock made a partnership with, sorry about that, with
ClearPath Robotics.
Yes, ClearPath. Yeah, ClearPath Robotics. And we want to really get your insight into what you found particularly interesting about that business and what you feel like, what value you feel like that business will provide in the technology that they work with.
Yeah, that's a great question, and ClearPath is a very good story of Canada as well. And so the company was founded in 2009, and it has since established itself as a leader in autonomous robotics development, and it creates one of the first platforms for robotic research back in the time. And then in 2015, the company actually started a new business line. It's called Automodels. And it focused on the use of autonomous mobile robots for material handling around the warehouse and the factory. And the focus of ClearPath, the reason why it is interesting for us is because it fits nicely into the industrial automation theme that we have here at Macro, where robots are there not to replace people, but to augment their capabilities, to do the repetitive work for them so they can reskill and focus on more sophisticated tasks. And it's really about, automation and reskilling, upskilling the workforce that you already have. So one of the other fact that could be very interesting to you guys about ClearPath is that the co-founders started the company straight out their university. And it is considered one of the success stories for University of Waterloo and the Waterloo region. And ClearPath, interestingly enough, is not the only company in our portfolio whose founders started straight out of university. Another company in our portfolio called SkySpecs, the renewable asset management company in Michigan, is another one. And it is performing very well as well, just like ClearPath in terms of commercial traction. And it really shows that with proper resource and ecosystem, if the founders are willing to be coached and to learn, you can build a feasible business, a very successful one in the B2B space, straight out the university. You don't need to have 20 years of experience and as an executive in a certain sector to start a business in this market.
Yeah, that is actually really interesting to hear about, especially since ClearPath is working in a space that is so new and there isn't too much history behind this. So it is cool to see McRock supporting businesses that are taking on, this pioneering approach. But going along with that, I would love to hear about a project from both Panache and the Women in Technology Venture Fund that you guys are currently working on that you find the most exciting right now.
Yeah, I mean, maybe one that I can share because it's funny because it was actually like the first deal I led from start to finish with Panache. But there's this company in Vancouver named Soul Savvy, and they're an online community for sneakerheads. And which is funny because it's like when we first saw it, we're like, wow, this is super niche. It's like, is it even possible to create like a venture scale outcome in something like this? And then, but what was really interesting and exciting about the company is that when we looked at their metrics, even though their community was small, like when we invested, they had about 2,000 community members, but their like daily active usage rate was 90%. So it's like these users were coming back daily. And what's even crazier, which kind of gets into how fanatical some people can be about things, is like they were paying $33 a month to be part of this community and to like interact with other people that are as passionate as sneakers as they are. And it's like, even though like, I didn't have a pair of expensive sneakers myself before investing in this company. And it's like, even though I didn't really understand it, I think what's interesting is like, as an investor, you may never understand, especially for like consumer businesses, you may never understand like, why Gen Zers love TikTok so much, for example, right? But it's like, but like the metrics were clear there and we're like, wow, this is really exciting. And like when we met with the founder, I mean, he kind of sold us on the company because it's like, the founder to us was just super impressive because like he was able to, like just pull resources to his company like crazy, right? So it's like, because he had this highly engaged community of sneakerheads, it's like a lot of his employees were actually community members first that like, they didn't really like their corporate jobs and they were like going on this platform while they were at work. And then like, he would like reach out to them like, hey, do you want to work for me? And then, so that was how he hired a lot of his community members. And it's like, you know, people like Ashton Kutcher wanted to invest in his Series A, and then so it's like, yeah, he was just amazing at pulling together resources. That's a company that I hold near and dear to my heart.
I like that company actually. Mine is similar actually. SheerTex is the name of one of our portfolio companies, and this is a company that's founded by a woman by the name of Catherine Hummel, who actually is a second-time founder. She started her first company, Shop Locket, which she sold when she was in her mid-20s and did really, really well, and then went on a journey to find a, she kept wearing pantyhose, which you guys won't get, but the girls will understand. So she'd get nylons and she'd put them on and they'd rip, and she'd just get, you know, pissed off, frankly, at the whole mess. And so she went on a journey to find a solution, and she developed a technology, and it is in fact a technology whereby she has created a fiber that when knitted together with nylon actually creates a pantyhose that is unrippable. You can't actually rip it. So again, for the ladies in the room that ever put nylons on and they rip, these ones actually don't. But what's very interesting about the tech is that the application of this technology is sustainable. It uses sustainable, reduced heat, reduced water in order to create the tensile product. And then when you put it all together and you machine it, it uses low energy. So what she's actually created is a product that can be sold in the international markets. She's got an e-commerce platform by which the company is selling. But she uses sustainable materials, and it's a sustainable business model that she's using by which to sell. So this is a company that she started, they actually attended CDL. So if you guys know CDL Rockies, so that she attended CDL Toronto, that's where we found her. And, but the company is just a rocket ship. And they're, you know, when you look online and just keep an eye on them, there will be some announcements, some announcements in the next sort of 6 months, but some very interesting, a very interesting technology and a very interesting company and an unbelievable team of professionals around this. And so if you think about what Lululemon looked like 10 years ago, this is what SheerTex is creating. And it's a very cool, multi-dimensional product. And you know, so I'm just like super thrilled that that they're in the portfolio, and just the way in which they're building this capability. They're going to become a B Corp. They're doing a whole bunch of different things that are going to be really cool. So they're one of my ones to watch. I'm the managing partner. I have to love all of my companies, but they're one of the ones that we think is a real rocket ship.
Yeah, that is really cool to learn about, just all the different businesses that you guys interact with, and especially the ones that are growing and hopefully become household names sooner or later. But to wrap up this panel discussion, just a super general question we'd love to throw out to all three of you. For students who are considering entrepreneurship, would like to start a venture of their own, or maybe even dive straight into venture capital as possibly an analyst, what's one piece of advice you would give to them looking back at your career and the experiences you've had? So I'll just hand that over to you guys.
Yeah, I guess the common theme here is, at least in venture capital, is work for free, right, Tim? I mean,
Yeah.
you know, I think, you know, entrepreneurship and venture capital is great in the sense that you can start from any backgrounds. Either you are a finance professional, either you are a tech professional, you can always get started. And it is the kind of career that require you to constantly learn new skills and new things. And I think, you know, looking back at my career, I think the lesson that I learned is you always need to find the connections, the kindred spirits that you know, complement you, that elevate you, and who gives you the first chance. And so, you know, look out and be very open-minded to talk to anyone that you could talk to and explore any possibilities.
Yeah, building on top of what Haja said, like venture, I guess most finance is like this, but VC is especially like this, where it's like it's a relationship game. So it's like most people that I know that have broken into venture, it's like it was because they had a pre-existing relationship with like a partner or something like that. And then when they were looking for an analyst, the partner reached out to them, right? So it's like, maybe more practically, it would be like if you're a student at the University of Toronto, it's like get involved with this club or like USEED or CDL or Innovate Calgary, right? And it's like, and eventually you'll meet investors in the ecosystem who can introduce you to other investors, or and then build relationships that way. And then eventually it's like if your relationship is strong enough and you have some of the skills needed, like they'll think of you when they're looking for an analyst. And then for, I guess, if you want to be a founder, it's like what we've seen is like there is no perfect timing to be a founder. So it's like, if you're coming right out of school and you have an idea, it's like, just go for it and then see how it goes. And it's like, if it doesn't go well, as like, we all know the rates for early stage startups, it's like you've gotten your first failure out of the way, and you just get back up and do your next one, and maybe that will be the next Google of Canada.
Yeah, and network, because that's how you're going to meet. Serendipity will take you there, but you need to kind of pinpoint the people that you think might be able to help you, and network. There's tons of opportunities in Calgary for that. Tim's just mentioned a handful of them, but there's lots of ways you can get involved. And Tim was with Next 36, and that program is based out of Toronto, but they do flyovers in Calgary and in Vancouver. But getting involved in those kinds of programs and identifying maybe potential partners that you want to work on a project together, you want to build something and trial balloon it. There's no reason why you can't do that and see whether or not it's going to work, because you just don't know. And the more you try, the more you'll learn how to iterate on your own, and you'll develop the muscle that is useful for being an entrepreneur, but also for being an investor, because we do that all the time too.
Yeah, those are all really great points, and definitely, at least for me, advice that I'll take and apply later on, hopefully. But so I think that concludes the panel discussion.